Okay traders, what's up? So in this video I'm going to be going over my outlooks for the S&P 500 going into the week beginning 10th of November. So I got a few questions about how I mark out the higher time frames. So in this video I'm going to be going over how I mark out the higher time frames using my 4-pillar approach. So the way that I do this, for those who don't know, so I'm just going to quickly run through it. It's a 4-pillar approach because it has 4 steps. Now you need all 4 steps for this to work. Think of it as like a table, and a table needs 4 legs. So the first thing is market structure, right? Now, when you have market structure, it's basically highs and lows. So I'm going to break it down very simply how I look at this. So there's no fixed amount of time you want to go back into the charts, because the one question I have is how far do I go back? It's not a question I can answer because there's not a fixed amount of time. But if I just go back to, let's say August of this year, just to keep it simple. All right, or no, sorry, July. So for me, that would be a nice structural high, swing pivot, structural low, and then structural high like this. Now, I'm going to start marking out the arrows like this. The reason why is because I feel that when you mark these arrows out, it gives you a much clearer indication of where the swing points actually are. So you have a structural high like here, structural low, and then just use this arrow again, and this arrow will tell you exactly where your swing point's going to be. So this is the structural high. Now, the reason I like doing the line is because you know that this is not a high, this is a high, right? Because we had no break over here. Then this is your low. And now from here, I'm going to speed it up a little bit, right? But again, just the same principle. You use an arrow and you just draw an arrow like this. Now, once you have this arrow, you look for, I'm just going to speed it up. So you have a structural high, structural low, and then structural high like this. So once again, we have seen a very clear shift in market structure, right? So we have a structural high, break over here, and now down here we have again structural low, right? So I'm using the arrows. Now the reason I draw these arrows is to show you exactly where there's been a shift in structure relative to each of the swing points. Now again, this is a structural high, structural low, and then structural high. So again, the missing arrow you see is structural high, low, and then high. So this is step 1, or the first pillar of the 4 pillars. Now step 2 is something which a lot of people miss out, but I think is very important. It's the dealing range. Now, once you have the dealing range, you then go on to premium and discount. So this is where your PD arrays come into play, right? But premium and discount and dealing range, they come together, but it has to be dealing range, then PD arrays. So let me explain. Our most recent low is down here, and our most recent high is up here. So once you've done that, you just project the fib, right, from the low to the high. So a lot of people, they don't understand how this works, right? So you just find the dealing range, most recent low to most recent high, and you project the fib, right? This is just on the 4 hour, so you only want to have it on the 4 hour. Now, once you've done that, you've got our market structure, then dealing range, then the premium and discount. So anything above this 50% is a premium, of course, anything below is a discount. Now, once you've done that, the last step is the fair value gap. Now, the fair value gap, or simply FVG, is what you find in premium and discount. So basically, if you see a fair value gap at the equilibrium, you don't ever mark that out because I don't like trading at the equilibrium. But in terms of the fair value gaps in the discount, so this is a fair value gap in the discount I think everyone should be aware of. So this is this is where the gap is going to be. So between these two lines is a gap. We just call that a fair value gap. It's that simple. So we just draw this and we get our key level like this. So the reason this is a key level or a POI is because it left a fair value gap and it's in the discount. It's a 4-hour fair value gap, so 4-hour POI, so it does hold some weight. So just by looking at this now, we can begin to kind of predict an overall higher time frame, longer term bias or perspective. Now, how we do that is quite simple. Once you have this, you basically want to be trading from premium back down to discount, right? Now, how we do this is very simple. You then want to repeat the same process, but in the premium. So in the premium, we have 2 specific levels. We have this level over here. Did price leave a fair value gap? Yes, a small one, just a very small one. So that, let me mark this out. So this here is going to be a key level, and so is this. These are our 4-hour POIs or our 4-hour key levels. A quick thing that I like to point out as well is the idea of a flip zone, right? So I call this a demand to supply flip. So the reason why is because, and they usually match up, right? So how I would mark it out is like this. So we had a fair value gap over here. Price obviously tried to hold its demand. We broke, and then we obviously had a huge sell-off in November. So this is how my key levels are looking. So on the S&P 500 or ES future specifically, this is how I mark out my higher time frames. So all the higher time frames focused on, we always, any market you trade, whether it's gold, whether it's Forex, whether it's S&P 500, whether it's NASDAQ, all these markets must use the 4-pillar approach. So you need to have, in this order, market structure, dealing range, PD arrays, fair value gaps. And then these lead to the POIs, right? The POIs. So this is kind of an overview of how I'm looking at the S&P 500 or ES future specifically. So now let's go to the 15. So on the 15, I don't like to have the 4-hour zones. I think they're a bit messy. So I'm just going to move them away for 1 second. So on the 15, we do more or less the same thing, right? But on the 15, I approach things a little bit more granularly, and I'll explain what that means. So these are my levels on ES, and I think everyone who trades ES or NQ should have these levels, right? But specifically for ES, let's go to Halloween. So Friday, the 31st of October. Now, the process of fair value gaps on the 15 become super important. You need to refine your levels on the 15-minute time frame. And this is what I'm going to be breaking down. So Friday, I was interested in this level. Now, I didn't trade this level. This was 5:30 p.m. So I'm usually not trading after 11:30 a.m. EST, but this is 5:30 in the UK. So this is a key level for me. Now, why is this a key level, or why am I interested in this key level, right? So basically, it's a couple of things. So Friday, the 31st of October, if this is the daily opening price, right, we're below the daily opening price, we've left a fair value gap, we've swept the Asian low, we've taken out the previous day low, right? So there's a lot of confluences that this is a key level I'm potentially interested in trading. But of course, this was Friday, so of course Monday we check back in on this level and we see how the market reacted to this level. Now, here's what's important to understand. Without going to the footprint charts, we can see very simply a bounce off this level, so a reject. So we can assume this is an area of demand, right? Nice and simple. So in the New York session, around 10:15, 10:20, we bounce off this level. Now, this was a crucial level from the week 3rd to the 5th of November. This was an absolutely crucial level, right? And I'm going to explain why that was. Now, this level on ES, so obviously it was broken on Tuesday, London session, right? So this level was basically 68.43 to about 52.53, right? It's that 10-point range. Now, this was one level that I was definitely interested in. I think those who trade ES will understand why. Now, again, it's the same principle. You're looking for a fair value gap that's just a 15-minute fair value gap, right? So once you have your 15-minute fair value gap, right, like this, let me label that. So once you have your 15-minute fair value gap like this, right, now, yes, it's the entire region like this. I do agree, this is the entire region. Your key level is going to come before the start of the fair value gap. So this is going to be your key level. And I'm going to explain why this is a key level again. But it's the same reason as Friday, right? So Friday, we were below the daily opening price, right? It's the same thing over here. So price has taken out liquidity. So previous week low, previous day's low, Asian low, the fair value gap was here. And also, we were below the daily opening price and the weekly opening price. So daily opening price was here, weekly opening price was here. Now, the reason this is a key level for me is because when we have all these confluences lined up, we want to be buying when price is below the daily opening price, because this is basically how a daily candle works. Now, if you look at the way a daily candle works, let me just change this to 1 day like this. What you're looking for is, there you go, to take a long position when price is expanding the wick. So you want to ride that wick, right? You want to position yourself when the wick is small and ride out that expansion. And the way you do that is to position yourself to go long inside of the wick. And the basic kind of logic behind this is that the market will open, will head lower, and it's going to find some kind of a support or demand zone here, we want to be buying back up to the daily opening price. So we're looking to catch the expansion of the wick, right? So we want the wick to be small. So we want the wick to be sort of this size. And when we exit the trade, we want the wick to be sort of this size, right? We want this, right? We want to be trading in line with the wick expansion, right? That's very important to understand. Now, when it comes to key levels, let's just go back to key levels now. So this was a crucial level. So I'm just going to start off by explaining 68.49, right? So 68.49 using order flow. So let's see how you could have broken this down. So again, everything is kind of streamed live in Discord, so you'll be able to see how the levels are reacting. So this was, if I just go back and find this level, and feel free to comment whatever people want to see in terms of order flow and using them at fair value gaps. Feel free to pop your thoughts in the comment section, right? So let's go back to this. Right, here we are. So here's the level itself. So if I make this a bit bigger, this is the level we're interested in, right? So I think I made a slight video on this. So you want to see this level here. So this is a zoomed in version, right, of this level. So let's kind of break this down. So this level, right, what we can see is as price came into this level, right, so what we see is we see positive delta. Now this is the reason it was such a strong area of supply. This candle, this candle, this candle, this candle. Now we had consecutive up candles, right? 1, 2, 3, and I guess 4 as well. Now what's interesting about all these candles, especially this candle, is if you look at this candle over here, right, we see inside of this zone a massive amount of blue delta, right, positive delta. So what that means is the aggressive buyers hitting the ask, so the right hand side, massively outweigh the number of aggressive sellers hitting the left hand side. So here we have aggressive buyers, right? Buyers are being aggressive, they're driving price up inside of this key level. Same over here, we see 192 for 366, 20 for 148. Here we see 249 for 400 and 439. Then right at the top we see 101 for I think that says 297, right? So then we see a break to the downside. So bearing in mind, we're interested not in the shape of the candle, the size of the candle, the wicks, the bodies. We are interested in the order flow. We're interested in the interaction between the buyers and the sellers inside of that key level. Now this is very important. The reason why people's fair value gaps work and sometimes they don't work is because they don't truly understand who is being absorbed inside of these zones. So just going to caveat that as well. So let's just move this away. What we want to see is this, right? So this was the level. So let's now go back to TradingView and see. So this was the level. Right, this was the level. So I'm going to remove that for 1 second. Bearing in mind, from an ICT perspective, I believe they call it a breaker. I think something like this. So again, or order block or whatever it is. So it's a mitigated order block, which then flipped from bullish down to bearish. So this is, of course, how an ICT breaker is going to work, right? But an ICT breaker isn't going to help you unless you understand what's going on inside, right? So again, just breaking it down, I made a separate video on this. So we have in this yellow box, we see aggressive buyers failing, absorption of buyers. Now think about it this way. Let's go back. If we break below this zone after seeing 1, 2, 3, 4 minutes of heavy aggressive buying, who is in control of this zone? Or let's go one step back. When you see aggressive buyers, right, are they trying to break price above the level or below the level? Well, they're trying to break price above the level. Now, this level we enter, we can either break to the upside or downside. Now, we break to the downside after heavy, aggressive buyers. So what that means is that buyers have been absorbed in this particular example, in this particular key level. So this is now ES key level, still an important key level. The absorption happened at around 10:30 a.m. Eastern on the 4th of November, Tuesday, 4th of November, right? So it's these kind of candles over here. So this move to the downside, right, after, towards or just after 11 a.m. Eastern. The reason that happened, the reason we had such a move to the downside here is because price was rejecting buyers over here. So what was going on here, very simply, was we saw aggressive buyers, right? Just going to write AGG, aggressive buyers, right? Price breaks below. So what does this mean, right? When you see aggressive buyers and price breaks below the level, this means that your breaker block or your order block, in this case, I believe it's a breaker block, they call it an ICT. This breaker block is a bearish breaker block, or in other words, it's an area of supply. There's an oversupply over here, and that's why the price moves down. And the reason there's an oversupply is because aggressive buyers failed, which means that passive sellers are in control. It's that simple. So that is what determines your key level, right? So this was a crucial key level because we had such a large absorption, right? This was a very big absorption over here. You can see that just with the highlighted region. So blue delta, blue delta, blue delta, blue delta, then we break below. So it's showing you there's a massive seller sitting over here. So when people say supply and demand, oh, I'm trading supply and demand, supply and demand isn't based off ICT concepts or fair value gaps. Supply and demand can be used with fair value gaps, but you need to back every fair value gap decision you make with the order flow. All right, so this is what makes a true area of supply in the market, right? Aggressive buyers have been absorbed. Now, what's interesting, and I also tell everyone to do this, is simply take these zones and extend them over to the right. Just keep extending them, and you'll be amazed to see how the market will gravitate back to these zones, because the market is built in a way where it will gravitate back to zones that have given reactions in the past. So we know going into Wednesday, right? I'm not going to do a deep dive on Wednesday's price action, but Wednesday we had a move to the upside, right? And it's not a coincidence that again we had these levels over here, right? So Tuesday and Wednesday, right? On Tuesday, we've just been through the example of how there's supply in control because of sellers. Wednesday's sell-off and Tuesday's sell-off all came at the same zone. Although Wednesday's sell-off, I believe, was quite late in the day, so 8 p.m. for me, so 3 p.m. UK. So this would have been in the PM session. So if you're a PM trader in New York, you could have maybe caught this move as well. Now, the point of making this video is just to establish key levels, right? How do you find key levels, right? Key levels or significant levels have to be found with the order flow. Now, once you have the key levels that have been established from order flow, just extend them to the right and you'll be amazed at what you see. So Tuesday, we had a long from this region, right? Wednesday, the fair value gap from Tuesday created another long, right? So this is now an area of demand, area of supply, back to area of demand, right? So we're just seeing the interaction or the flip from demand to supply to, again, Wednesday AM session demand. So we've just seen these three things playing out. Now moving into Thursday, right? And this is where trading for me becomes quite simple, because when I go to Thursday, so this is now Thursday, the 6th of November, you are in, there you go. So you are only interested in trading at these key levels. So once you have your key levels established, so this video I'm making to explain key levels and to just break down my key levels for the week. Once you have your key levels established, just wait for them. Just wait for them. So basically what that means is do not get caught up, do not get chopped up in any of this price action. Once you know where your levels are, levels, just wait for them. And once you wait for your levels, you can either buy or you can sell. It's that simple. Now, Thursday, we had a sell-off from here, right? So Thursday gave us a very aggressive sell-off from here. Again, we had an area of demand, which flipped to supply, then an area of demand, then we flip to supply. So we're seeing buyers in control, sellers in control, buyers in control, now sellers in control, right? I'm not going through it on the order flow, but you can prove this on the order flow, right? I think I maybe took a screenshot of this. So Thursday, the 6th of November, we should be, here we are. So here we are. Here's a quick trade from this level. I went break even on this trade. I sold early, right? Price came back to my entry. I sold a little bit early, right? So again, just to quickly break down this scalp that I took, which didn't really make any money, what we can see is without even reading the numbers of the order flow, we see blue delta, positive delta, right? Positive delta execution over here. So when you see a lot of these aggressive buyers and a move to the downside, right? Who's in control of the price? It's the sellers. So we're at an area of supply. I think someone did catch it. So we're at an area of supply, right? Simply because buyers are being trapped, right? So this was now again 1022, 1023, 4, 5, 6, 7, right? So here, right, if we just look at the footprint charts, what we can see, again, without reading the numbers too much, we can see a lot of blue delta, 44 for 305, massive difference between the aggressive sellers and the aggressive buyers. And now we see a 0 at the top, which indicates a finished auction, right? Buyers and sellers are no longer interested in trading at that price. We begin to then see a melt through, right? And this is where the sell-off happened just after 10:30 Eastern. So what I'm trying to explain to traders is once you come into your key level, so again, this key level 6,800, exactly 6,800, right? So 6,800 was around here, so this wick. Notice how we have a key level, a fair value gap, a wick above, even from basic understanding, means that price couldn't close above this level, right? So therefore, there must be something driving price down. It's sellers, or specifically passive sellers, right? So those passive sellers, we see it via this chart over here. Tons of aggressive buyers. We break below, which means at 6,800, these buyers, these aggressive buyers hitting the ask, failed. They were rejected. They were absorbed. They were trapped. They were unable to see follow through. Follow through happened the other way. So who's in control of the price? Sellers, right? Passive sellers were absorbing the aggressive buyers. And that's why we see price moving down the way we did. So 6,800 for ES traders, a crucial level of supply, as well as 68, I think it's 68.50, right? So 68.50, let's write this down, 68.50 and 6,800, these two are prime levels. These are prime levels we want to be looking for trades, okay? Well, looking to see how price reacts at those levels. So Friday, of course, we had a very, very typical, I think they call it TGIF, right? That reversal on a Friday. So if you look at the way the weekly candle was forming, this is where the weekly candle becomes quite powerful. So moving into Friday New York session, we had the initial sell-off. We didn't quite hit our 4-hour PY over here, which is fine. And then, of course, what we can see is we can see that wick forming. So after such a heavy bearish week, Friday does often reverse, right? I think that's an ICT concept that a lot of people know. TGIF, they call it. So now from here, this is where it gets interesting. We want to look at our game plan going into the week ahead. So here's what the game plan is, right? So this is what I'm looking for. This is now the S&P 500 on the 15-minute chart. So again, very quickly, let's go through our market structure. So we had, well, let's see this. So structural high, low, then we had a high. So then we broke here, low, high, low, high. And then from here, depending on how you do it, you can have your low, high, and then low, just like this. So this would be our dealing range like this, right? So here's our dealing range. So now what we're looking for is this. We're in a premium, right? Oh, sorry, we've just tapped into a premium, but realistically, I don't consider this, well, this is too close to the EQ. So I don't trade at the EQ. So what we can do is if we can respect Friday's low, then of course there was another level over here, actually flip zone, which I forgot to mention. So Friday, we had another good key level over here. So market open, 15-minute fair value gap here. So here's where the key level would be. We had a nice break and retest very late in the day, again 8 p.m. so not ideal trading time for me. This is my key level. So here are my levels going into the week, right? So I'm mainly focused on these top two levels. So 6,800 and 6,850. These are my key levels. I'm not looking to trade at 67.60 because this is too close to the EQ. So what the game plans are, right, is this. If we can respect this level, we're in discount. I'm happy to take price long from around 67.25 to 67.95, 6,800. This is one potential game plan. Now from here, if we break above this, we can use this as a break and retest to then target 68.45 to 50 area. And if we break above 68.50, then we are probably off to the races, and we're probably going to see another all-time high, as there's an Asian high over here. So this is my plan going into Monday for the S&P 500, right? Determine your levels, determine your structure, wait for your levels to be hit, and execute at those levels.